scientific background to some trading seasonal maxims that are really understood in the financial world. So first thing to say is seasonal patterns do occur in many different markets. They occur in the major indices. So obviously I'm talking about the leading US indices, S&P 500, NASDAQ, Dow Jones, Ftse 100, etc. They happen in stocks, particularly to do with earning seasons. You'll notice that certain stocks have a habit of outperforming at certain earning seasons, which means you can narrow down a certain window within which you can have an above average return, but only expose yourself for a minimum amount of time. I'll give you some examples from my own trading where I've done that. Just recently, we've had some technical earnings out from Netflix, Microsoft, and I'll run through some seasonal pattern that I've been doing with that. Currencies. Interestingly, there's often taxation reasons that currencies tend to move or fall at any particular time. I'm going to share with you one currency that has a very important taxation reason for falling and rising in the last months and the last few weeks of the year and the first weeks of the year. I'll give you an example of that as we go through. Commodities, obviously things like silver, gold, copper, platinum. Many commodities have industrial usage, and industry will have certain times of the year where it's particularly has heavy demand for a commodity. That obviously is impacting the price and when purchases are made, and you can see over a period of time certain trends develop. Also, you see similar in the bond market as well. So these technical patterns, they also occur over many time periods. So you can get them happening yearly, monthly, weekly. You can even get repeating events, and you can even get patterns intraday. So that's patterns that are happening within a certain time of each day. That's how predictable it can be, to do with money flows and just the general process of financial workings. You have certain opportunities within them. We'll go through some. Now, you might think, well, why do they happen? I've touched on some of the reasons, and here's a list of them. So, for instance, sometimes it comes down to weather patterns. It stands to reason that if there's a drought or if there's a particularly hard frost, it might impact the price of commodities like soybeans or wheat or corn. There's also harvest periods. Obviously, commodities and crops in particular are harvested around the same time each year. This impacts prices. You tend to see higher and lower prices at certain times of the year, depending upon the harvest period. You also have interest payment timings. For instance, often bond yields will be paid at a certain time of the year. It's no surprising that when these bond yields are paid to major investment companies, you also then see large inflows into equity markets. So sometimes just the payment of interest payments works its way through in the financial system. Sometimes it's investor sentiment. So for instance, there is a phenomena called the Santa rally, which is around Christmas time. You tend to see US stocks rise. It's just the fact that it seems to be a time of year when people, they're used to purchasing things, they're used to giving, and there's a sort of a general good mood that as actually flows through into equity markets. You also get regular fund flows. So for instance, sometimes funds tend to purchase stocks at similar times of the year, and you can track the levels of those fund flows and see the impact it has on markets. So now let's look to another question. How reliable are they? Well, they can be very reliable. But the first thing what I would say to you is there is a note of caution with seasonal patterns. Is just because something has happened in the past, it's not an automatic guarantee that it will happen in the future. And obviously you can have some quite interesting dynamics that take place that myself as a trader and as advising HYCM clients, this is where the skill level comes in, when you recognize when is a seasonal pattern a great opportunity and when is a seasonal pattern best ignored. That's where the higher level of skill comes in, and when you recognize the good time to follow the seasonal pattern versus a bad time. I'm going to try and show you some of my own trading where I've tried to differentiate between a good time to follow a seasonal pattern and then when it's perhaps more sensible just to wait. So there is a nuance to seasonal patterns. And a word of caution, in case after I've shared this material, you might think, well, this is great. This is a surefire way of trading successfully. You have to be aware that it's much harder to do this in practice than it is to see it in theory. Actually executing these is another skill. So just to bear that in mind as we go through. Okay. So here's one example of a very well-known saying in Wall Street, which says, sell in May and go away. You would have heard it almost certainly. And it's a trader's maxim that's passed on to traders time and time again. And if you look at the chart on the screen, what you can see is the red line would be if you purchased the shares of the Dow Jones index between May and October. So if you'd done that from 1960, you bought in May and then sold the index in October, you would have made virtually nothing on your return. Now, if instead you had bought the shares of the Dow Jones in November and then sold in April, and if you'd done that every single year since 1960, you can see you will be up over 3,000% of your initial investment. So that is a really phenomenal difference between the two. So there is one very simple seasonal trend that most people could use to their advantage with either managing their own pension, perhaps managing a longer term investment, simply buying one index, and instead of just buying and holding it, simply buying it in November and selling in April each year gives an above average return. Now let's look at why this is. Is this just coincidence? Is it a strange fluke? No, this is what makes a seasonal trade. There is a specific fundamental reason for it. We're not just looking at patterns as though you might be looking at patterns of clouds in the sky, and you might look at the clouds and say, oh, I can see a dog or I can see a fish. It's a good fun thing to do, for sure. But in the pattern that we're seeing here, there's a specific reason. So the reason is that large fund flows into equities enter the equity markets around these times. So if you look between November and April, you can see that large amounts of fund flows come into the equity markets. And as those fund flows come into the equity markets, equity prices rise. So it's a very, very, in one sense, simple explanation. And once you've been told the information, once you've been shown the information, it becomes obvious. So you can see, well, this is, you know, a very clear example of a seasonal trade. Now, another seasonal pattern, and this is the seasonal pattern of the Santa rally, and you can see that over the last 70 years, the S&P has risen 53 times between December the 14th and January the 4th. So in just a few weeks, you can see these very large returns. And you can see often the returns are over 5%. So that means just for holding the S&P 500 at that very short period of time can give you some very good returns. And obviously that's been the case 53 times, but obviously 17 times it hasn't. So you can see the seasonal pattern can be very reliable, but it's not foolproof, and market conditions do result in some variations in different years. And obviously the skill is recognizing when the year will be different. So here we have the pattern of the S&P 500, and you can see here, I'll just explain this chart. This is courtesy of a product that we are offering our clients called Seasonax. And Seasonax breaks down these technical patterns into very searchable and very accessible data. So here's an example of the S&P 500. We've looked at that from the 14th of December through to the 13th of December. If you see the top right-hand side of the square, you can see the date. You can then see the annualized return is 35%. You can see that the maximum profit that was gained was 7.98%, 57 times out of the last 71 years, and the average return is 1.34%. So in other words, if you just held that every year, you would on average receive 1.34% for this Santa rally. Now, obviously, knowing this information can really help with market timing, particularly for those who are intraday traders or people who are trading the markets very regularly. This kind of information can be very helpful. So you might think to yourself, well, is that just true for the S&P 500, for the Dow Jones? What about the UK Ftse? Well, if you look at this chart here, you see three lines, the red, the green, and the blue. The red line shows you the return in the Ftse 100 over the summer months. So this is if you bought the Ftse 100 in May and you held it through to October, you can see that your return would actually be sub 100%. So it would be sub what you put in to the Ftse 100. So a very inferior return given that you've been investing since 1984. However, if you had only invested between November and April, so if you buy October the 31st, the Wall Street maxim is you buy at Halloween, so you buy October the 31st, and if you held it through to April, you can see that you would have done better than the Ftse 100 index itself. So you can see you get superior returns by buying in November and April than you do for holding the Ftse 100. So this seasonal timing is important for the UK Ftse 100 as well. And these patterns aren't just seen in US stocks or UK stocks, they're also seen in many stocks around the world. So if you look here, you can compare the average return for stocks invested. If you look at the top left, you've got Canada, China, France, Germany, Hong Kong, etc., etc. And you can see the summer months in Canada, you would end up losing minus 0.22% between 1970 and 2020. So you would be losing money by buying Canadian stocks in the summer. Similarly, losing money in France, Germany, Japan, Taiwan, the UK. So buying stocks in these summer months would actually end up with a negative return over all of those years, some of them going back from 1970. Well, then if you look at the green column, where the column is highlighted in green, you can see here that the winter returns are very good. You can see that the Canadian winter return actually exceeds the total return. So you can see the total return of the Canadian stock is 5.45%, but the winter return is an even better 5.68%. In other words, you get rewarded for holding your money in the shares for less time. As an investor, that's not only a profitable piece of information, it's also extremely useful because it means you can put your capital into some other investment. Similarly, Chinese stocks, a whopping 12.03% holding over winter, just underneath the overall return of 12.10%. Look at the French metric, that's a very strong one. You can see that France, 6.74% gains for holding it in winter, as opposed to 3.28%. Now, obviously, the pattern doesn't always work. If you look, for instance, with India, you can see that India's gains are 6.25% in the winter, in the winter, but they're also 5.79% in the summer. So for the Indian stock market, you would have been better off holding the index all the year. So you can see there that there's a range of different indices for you to look at. You can take a screenshot of this. I don't even mind passing on this information to your professor, and she can hand it out to you. But one of the things that I would finally end on with this slide is if you look at the average return shows that you are much better off holding major indices for the winter months than you are for the summer months. And that can be extremely advantageous for a portfolio or for just your own personal finances, knowing when's a good time to buy and sell based on those fund flows. And remember, the reason for this is to do with the fund flows that come into equities. So the obvious question would be, well, when would this pattern change? Well, it would change if the inflows to funds changed. So say there was some new regulation or there was a change in the way investments were done, and all of a sudden funds would start flowing in the summer months, you'd expect this pattern to change. So you have to be aware of why you're seeing those seasonal patterns. Here's a seasonal pattern that you see in currencies. Now, this is the dollar index seasonal moves over the last 25 years. The axis on the bottom of the chart, the horizontal axis, is the time of year, going from January through to December. The vertical axis, going from 100 to 102, is a standardized return for the dollar index. And this chart visually represents the falls and the gains of the dollar index. So what you can see over the last 25 years, that the dollar index tends to rise at the start of the year and it tends to fall at the end of the year. Can you see that? Now, there's a specific reason for the dollar moves, and this is a seasonal pattern that stands up over 50 years. And what tends to happen, because of the way that US taxes are calculated, it is to a company's advantage to move US dollars from parent companies to daughter companies to save taxes. So because of that taxation issue, and it makes a company more tax efficient, obviously a good accountant will be exercising their skill to limit taxation for a company. And that means that at the end of the year, money tends to move from parent companies in the US out to daughter companies. So we tend to see the dollar depreciate into year end. Similarly, once the books have been submitted and once the taxation advantage is gone, well, then you just bring the money back from your daughter company back to the parent company. So that means there's a lot of dollar flows happening at the end and the start of the year. So we can see here that seasonal pattern, and this is the pattern we're after, has a fundamental reason. There's a reason for it. So here you can see the dollar index, and you can see here the top right of the screen, the 21st of December to the 1st of January. What you can see there is you can see this is the return of the dollar over the last 25 years. So in the last 20 years, you can see that sometimes the dollar index has fallen over 2%. Now, when it's gained, which is 5 times in the last 25 years, you can see that it's gained, but only by 0.83%. So if every year you had sold the dollar index on the 21st of December until the 1st of January, you would have made an annualized return of 20.20%. So it would have been to your advantage to have sold the dollar index each year for the last 25 years for just holding it for 9-10 days. So you can see those flows are short and they're sharp, but they are predictable because of those taxation reasons. So I'll show you how this is helpful for a trader's perspective. It's helpful because when you know this seasonal pattern is coming up, it can give you some real advantage in your trading. So here's a trade that I took this year in my account based upon this fundamental seasonal pattern. Now, I didn't just sell the dollar because of this pattern. Instead, for me, what I'm looking for situations when the fundamentals for the currency is in line with that seasonal pattern. So heading into the end of the year, many analysts were very bearish the US dollar. There was concerns about the US economic recovery at the end of last year. There was concerns about the way that the COVID-19 crisis was being handled in America and rising cases. There was a widespread expectation at that time that emerging markets would recover much more quickly than the US, and that there would be outflows from the US, and the US dollar was expected to depreciate. Some analysts were predicting a 10, even a 20% decline in the dollar index. So the point I'm trying to make is that I'm just going to pull my blind down. One moment. That's better. You can probably see me a little bit better now. So the point I'm trying to make is that the market environment was biased towards selling the US dollar. So all of a sudden, well, look, we know we have reasons for selling the dollar index. We have a strong seasonal pattern. We also have market conditions which are very bearish for the US dollar. So you can see, well, this is a great opportunity to sell the US dollar. There were some technical reasons on the chart, which is another topic for another time. But you can see here, this is a trade from my own account. You can see I sold the dollar index. You can see the little red arrow. That's where I sold the dollar index. And I sold it down to around the 89.40 region, just above, which was an obvious place to take profit on the trade. And you can see the date along the bottom. That was at the end of December, coming in to year end. And I didn't want to hold into January, of course, because we know our seasonal pattern. What happens in January? You tend to see the dollar index rise as the money comes back in. So I knew that this trade was short-lived, but there was an opportunity of a couple of weeks where it would be the right time to sell the dollar in order to take advantage of market conditions and that seasonal pattern. So there's an example of using seasonal patterns in day-to-day trading, and that could also be very useful for purchasing dollar purchases for any company. Knowing this kind of information can really help purchases of commodities and can really be advantageous to a company. If you understand these seasonal patterns, it can really help with timings of payments that can be of great benefit to the company. So here's another seasonal pattern. This is gold prices from end of December through to middle of February. Now, gold is a commodity that tends to have a very strong seasonal pattern. Now, the reason for the strong seasonal pattern in gold is that around the Chinese Lunar New Year, there's a tradition in China is that you purchase gold gifts. Now, particularly in the east of the world, giving gold is a very good gift because unlike the Western world, you come used to, the currency, the dollar, the pound. You don't think, oh my goodness, is my currency secure? But in the further east you go, and the less stable a country's currency is, you look for something of value. Now, one of the assets that has been very well respected throughout the world as a store of value is gold. So giving gold as a gift in the Chinese Lunar New Year, or you can see gold rises in August, often given in India, Diwali, for weddings. It's seen as this store of value. So it has a traditional appeal that's repeated year on of giving gifts at this time. That impacts gold prices. So you can see here in gold prices, this is gold prices from the end of December to the middle of February. And you can see that over the last 10 years, gold has risen 9 times out of the last 10 years. So there is 9 gains and 1 loss from buying gold in the middle of December and holding it through to the middle of February. And if you'd done that each year, you would have had an annualized return of 45.28%. Now, again, I'll show you how I use this to my advantage, and I'll also show you how the pattern hasn't worked this year, but yet I've still managed to profit from it. I'll show you how that's worked. So this was a trade I took on buying gold at the end of last year. Now, the other thing that drives spot gold prices is the Federal Reserve. As you will all know, the Federal Reserve is the world's most influential central bank. And what the central bank does, the rest of the world banks generally follow. Now, if you look at the chart, you can see here I bought those 2 blue arrows, and that was buying gold after the last Federal Reserve central bank meeting, because I needed to make sure before I bought gold that the Federal Reserve was not going to change policy to mean the dollars grew in strength, which would weaken gold. I needed to make sure that the Federal Reserve was going to stay neutral. They weren't going to be changing their current policy. I wanted everything to stay the same. So once that policy meeting finished on the 16th of December, it was then clear to me, right, that means this seasonal pattern for gold should come into play. So taking advantage of that seasonal pattern, and you can see that I bought in around 1850 and I sold out 2 of my positions for 1922. You'll see I kept a 3rd position. Now, the reason I kept the 3rd position on was because of this seasonal pattern. And I knew that seasonally, there was a lot of advantages to holding gold. And because of the Chinese Lunar New Year demand, there was a high probability that prices went higher. Prices didn't go higher. There was some change in market conditions, and the seasonals didn't play out this year. But you can see that in anticipation of the seasonals, I took 2/3 of my position at a profit, and my final 1/3 was taken out just around break even. So even though the seasonal pattern didn't work out, if you know, in terms of just looking at it from this period of time, you can see that the timing and being aware of that seasonal pattern in conjunction with the central bank policy still enabled you to make a profit with that seasonal knowledge. Another commodity that benefits at the start of the year is platinum. Now you can see this is platinum prices over the last 34 years. And you can see that there's a tremendous bias for platinum gains. Now, the reason for these platinum gains is based on industrial purchases for platinum. Platinum is used a little bit in jewelry, but that's not its primary use. It has industrial usage, used in catalytic converters. And when companies are making their plans for the year, platinum purchases are often made, for whatever reason, at the start of the year. And either platinum purchasers aren't aware of this pattern, or they don't care because they're buying for a different purpose. But either way, large orders of platinum tend to come in at the start of the year. Now, this year, there was even more advantages for buying platinum because there was a supply and a demand imbalance. The demand for platinum was expected to outstrip supply for the next 2 years, according to the World Platinum Council. So all of a sudden, there was strong seasonal reasons, and then there was also strong fundamental reasons for Platinum's gain, as well as the fact that the global vaccine rollout was lifting commodities around the world. The dollar was falling, commodities around the world were rising, the world's expecting to get back to work again, and global synchronized growth is expected to take place. That typically boosts commodities. And so Platinum had a number of elements going for it this year. So again, that was a seasonal pattern that I've been speaking to HYCM clients about for some time. And you can see here, here's a trade that I took. You can see I bought Platinum prices around 14th, 15th of December, and I sold them in January. And you can see that Platinum prices have benefited from those gains. Now, I didn't particularly execute that trade very well, but it's a good example of how Platinum does have prices rising from that time of year. Now, what about some individual stocks? Well, one of the benefits of the product we use called Seasonax is that it can drill down into individual stocks. And this was a stock that I bought this year for just a few days. Now you can see here, there's some really outstanding returns that can be had on some of the tech stocks. Now, in the COVID-19 lockdowns, the so-called stay-at-home stocks have done very well. Facebook, Amazon, Netflix. As people have been at home, there hasn't been much to do. So those technical stocks have been really doing well. And Netflix was a technical stock that I thought, well, you know, given the fact that we've had such extensive lockdowns, I wouldn't be surprised if Netflix beat their earnings again. So this is why Netflix tends to do very well at the start of the year. You can see I've highlighted from the 18th of January to the 1st of February across these 2 weeks. You can see that Netflix, on some occasions, in 2013, it made a 66% profit. That's a phenomenal return, considering you might be holding a stock for just 2 weeks. And then if you'd bought Netflix on the 18th of January and sold it on the 1st of February, in other words, when those initial earnings come in across that time period, you would have made nearly 3,000% return. So that does show you that there are some real gems of opportunities to be had, that with a careful risk management and understanding how to execute these trades, you can really get some very good returns. And that's really a good one for this time of the year. Here's another little saying. You might have heard the expression turnaround Tuesday. It's something I hear many, many times in my work. Oh, it's a turnaround Tuesday. Now, what a turnaround Tuesday means is when equity selling on the Tuesday becomes equity buying. So if you look at the S&P 500, if you look at this chart, you see the breakdown of the intra-week returns. So if you look at the S&P as a whole on the left, you can see that the S&P and the whole on the left, on average, you've got a day-to-day gain of around 2%. Now, if you look at the Monday, you can see that Mondays on average lead to a loss of 1%, and Fridays on average lead to a loss of over 1.5%. But look at Tuesday. Turnaround Tuesday tends to have gains of over 3%. Now that means, if you look at the chart on the right, if you just bought the S&P 500 on Tuesdays and sold it at the end of the day, you would have done better than the entire S&P 500 index from 2000 to the present day. So for just 1 day a week, if you bought the S&P 500, Tuesday would be the day. Now, there are some psychological reasons for that. If you think about it, many experienced traders will tell you if you get a down day on Friday, Monday tends to follow suit. And if you think about it, because the stock markets are closed over the weekends, what's the last thing you want to be doing to ruin your weekend? Well, I'll tell you what ruins my weekend is if I'm in a position that I'm worried about over Saturday and Sunday. It's horrible. It's horrible. Psychologically, you just don't want, why do it to yourself? You just exit the position. So that's what happens on the Friday. You don't want to be going into the weekend with unnecessary risk. So if you're worried about your position, you will close the position, you'll book in the profits for the week, and then you can always open again on Monday if you wanted to. But what you tend to see is down days and Fridays result in a down day and Monday, and then you have, lo and behold, the turnaround Tuesday. So sometimes information like that can be very helpful. Now this becomes an advanced skill, but when there was a reason for selling stocks on Friday, and then Monday there was still a little bit of that negative sentiment, but then Tuesday comes around, and if there isn't any fresh negative news, maybe there's some underlying general good news that's in the market, then that can be a good hint of like, this is a good time to buy in on a Tuesday. So that's often the last couple of Tuesdays, you would have noticed that we saw a turnaround Tuesday, and that's being true to that intra-week pattern, which is mainly a psychological pattern. And also Friday, if you're going early for the weekend, you want to close your position out. And everyone has a slow start on Monday, don't they? Including the stock market. So there's some word of caution here. So seasonality is based on historical data, but not every year is the same. So you have to be aware, you can't just trade it blindly. There are often fundamental, psychological, and political factors influencing the course of individual years. So some years are contrary to the seasonal trend. Sometimes the seasonal trend is enhanced. So that's where the skill comes in. And that's one of the things I focus on advising HYCM clients, is highlighting seasonal trends that are relevant and trying to maybe just, explain why some seasonal trends are less relevant. So, and extreme movements in certain years can have more of an influence. So that can give you a false pattern. So you have to be careful if you're looking at the data. If one company had a very good year and it made 150%, like GameStop would it probably have done by the end of today, it would have had a very good day. That doesn't mean that the data is good all the time. So you need to make sure that there's an actual reason for the pattern, rather than you've just seen a very interesting pattern, but there's no actual underlying cause that's driving it. So that comes down to the end of my webinar. I do an online trading workshop for HYCM clients on Mondays and Wednesdays, and I help HYCM clients understand what's going on in the markets day to day. And seasonal trades is part of the analysis which I do in order to help my clients. This is a great opportunity now for any questions and answers that you have. So if you have any question and answers, please do let me have them now, and I'll try to do the best I can to help.
Hi, sir.
Hi,
Hello,
Yusuf.
sir.
Please. Yeah, we can hear you.
Hi, I'm
Hello,
Yusuf. Nice to meet you again. I actually joined your webinar a couple of months ago.
Oh, very good, Yusuf. I remember. It's good to see you. How are you doing?
I'm very good. Thank you for asking. I couldn't actually wait to join this time. After the first impression you gave us, you always give us beneficial information that we can use in our daily lives.
Thank you.
My question is, considering the current situation and the pandemic, the unemployment levels and the cut in salaries, I was amused how Apple surpassed its quarterly revenue for the first time in history, 100 billion.
Yes.
Can you, from your research or experience, give me any explanation or cause to it?
Well, the reason is, although many people have lost jobs, and although the situation for economies has been bad, the stock markets have been rallying higher because of all of the monetary stimulus from central banks and the fiscal stimulus from governments, what's essentially happened is that our present state has been maintained by borrowing. So many companies at countries have had furlough schemes where workers who have been unable to work, or companies who've been unable to pay their employees, have had that subsidized by the government, and the government has subsidized them by taking on extra debt. So that means that some people's incomes have actually gone up during the COVID-19 lockdown because they're not commuting to work, they're not buying expensive lunches, they're maybe not having to pay for childcare. So all of a sudden, they have more disposable income. So
yes,
a great opportunity, wouldn't it? Well, I will get Netflix for the year, and I'll get Disney Plus because I've got all the kids with me. And you know what I could do with a new laptop, and I'm making these Zoom calls, and I could do with a new phone, and we have saved money on the travel that we otherwise would have done. So that's why certain stocks, they've been called the stay-at-home stocks, Facebook, Amazon, Netflix, Apple, that's why they've had excellent gains. Let me show you one chart. So the NASDAQ, which is the technologically driven stock market, you'll see here, this is the NASDAQ chart. This was the drop, Youssef, in March 2020. Did you see that we took out recent all-time highs? We took them out of June, the middle of last year, and then price has nearly doubled since then of the NASDAQ. Now, the NASDAQ, over 50% of the whole index is made up of a handful of companies: Tesla, Facebook, Amazon, Netflix, Microsoft. So those earnings have come in pretty strong. And you can see that those companies have done very well during the COVID-19 lockdown. So that's why, A, consumers have had money to spend because of extra debt that the governments have taken on. And that's why, B, tech stocks have done very well. And if interestingly, I was just speaking to your professor earlier about Bitcoin, and we saw those huge rises in Bitcoin at the same time. And you just think, well, isn't that poetic? Because we're in a digital age with a digital reliance on technology. And so it stands to reason why a digital currency all of a sudden becomes popular, especially as some people haven't even been handling cash because of the fear of passing on the COVID-19 virus. Does that help, Youssef?
Yes, very much, actually. You opened my eyes to many aspects I didn't have in consideration.
Thank you.
But honestly, sir, I think Bitcoin, it's mostly people joining for the fear of FOMO, fear of missing out.
Yeah. And interestingly, this time, a lot of big investors were joining in Bitcoin rise. Was in December 2017, the rise was largely driven by retail traders. But this time, it was driven by a lot of serious investment firms. Ooh, you can see platinum moving a lot higher there. Okay, so I'm getting distracted.
Any other question?
Thank you, sir.
You're very welcome, Youssef.
You always really answer my questions to the point I can't even follow up with the question.
That's the great compliment, Youssef. Thank you.
Yes, thank you.
Any other question?
Yes, hi.
Yes, hi, Ali.
Hi, Ali.
So today in the news, headline news, that there are stocks that are risen above 1,000%, like GameStop, AMC, or COS. These stocks are short squeeze stocks, and what do you think about these short squeeze stocks?
Well,
one
Ali,
that investors are doing now, that they are over leveraging with these stocks.
Ali, well done. You've covered the bases there. I really such fascinating times. I think we're standing on a very pivotal moment. What happened, for those of you who don't know, to make it very simple, is that there's a Reddit community group called Wall Street Bets. And on that group, what you're seeing is a real interesting frenzy of naive investment. Now I'll show you the group. Let's see. This is the group. Now, on that group, I'm not going to show you because some of the language they use on the group is very horrible. So I'm not going to show us the group, but I'll explain to you what they do. There's a group of investors who've decided to try to support a company called GameStop. Now, GameStop sells second-hand computer games, as far as I'm aware. And a number of investors thought, we don't want to see this company fail. And a couple of Wall Street hedge funds were shorting the stock. In other words, they were betting on the company eventually folding. So what a number of people on this group have done is they've got together and they've been buying call options in order to bet on the price of GameStop rising. Now, they've been using heavy amounts of leverage to buy these call options. So what that means, and they've been using these platforms like, are you aware, like Robinhood, Trading 212, it's commission-free platforms where investors can, retail investors can buy and sell stocks and shares with very low or no commission at all. You know, typically, if you went to a bank and you wanted to buy some stocks or shares, they would charge you enough money to make you think carefully about whether you wanted to buy that stock or share. Now, on Robinhood, it's a platform and you can just buy or sell and it's commission free. So in other words, it makes it very easy to buy and sell lots of shares. They also give you the opportunity to buy options. Now, they also allow you to buy those call options using leverage. So what it means is you can buy a position that seems small, but is much bigger than you otherwise would be available to do. Now, if enough people do that en masse, that means that it's quite possible to really shift and move markets. And that's what's been happening. This community has been moving the market. Now, they've done it in such large volumes that they're forcing the price of GameStop up and up. There's a technical event called a gamma squeeze, which happens that as price gets closer to the strike price of the option, it means the hedge funds are forced to buy more and more shares. So it's just forcing the price of the stock up and up and up. And it can keep going up and up and up in a very painful loop. And some hedge funds have got badly caught out by this. Now, normally they wouldn't worry about it because there's no one big enough out there to push prices high enough. But because these retail traders have got together, they're coordinating on this community group. Now, on Friday, there were 1.9 million people on the group. I checked before I came on this webinar, there's 4.2 million. So the community group has doubled in a few days. And when you look on the group, I wanted to show you, but I suddenly remembered actually the group has some very bad language in the comments, so I didn't think it was appropriate to share. But what you see is there's a frenzy going on. People are saying, buy GameStop, buy and hold forever, buy and hold. We're going to make lots of money. Some people have made a huge amount of money. Some people have turned, sort of a couple of $1,000s into a few $100,000. That becomes a very, very potent and powerful, incentive for newcomers. And so it becomes almost like a fever. And the whole community is full of people in a feverish frenzy trying to buy stocks. And they're buying the cinema stock, AMC. They're buying BlackBerry. They're also buying Nokia. There's also some talk on them buying into even commodities, trying to do the same phenomena, a short squeeze. So the thing that many of these investors don't realize is if they're buying in using leverage, they can lose everything they've got in a very short period of time. So some of these investors are new investors. I had a look through the comments, and some people were saying, this is my first time in buying a share. Some people were saying, I don't understand this. What do I need to do? and they're just getting caught up in a sort of a speculative frenzy. And that's what's going on. And you might think, well, you know, that won't impact stock markets. Well, it has. Even Jerome Powell in the Federal Reserve press conference was asked about it last night. And you can see here, you had some heavy selling in the S&P 500, and that heavy selling was just based on these GameStop stock rises. Now, well, why does that impact stock prices? Well, what it means is that this indicator went higher, which is called the VIX. I'll show you it. Now, this is the VIX is the indicator of higher volatility, okay? And if you see here, the candlestick chart is the VIX chart. When that rises, then you can see that stocks fall, okay? So rising volatility, falling stock prices, the turquoise line. Rising volatility, falling stock prices. Rising volatility, falling stock prices, okay? So you can see here, rising volatility on that short squeeze. Some funds have had to borrow money from other funds. They're scrabbling around. They're trying to cover their, cover their problem, and it's sending the market into a concern. Then some highly leveraged positions will be closed because funds will need to access funds. That creates a ripple effect, and that you have a lot of money coming out of the market at the same time. Volatility goes higher. We see stock markets falling. It can become almost like like a fire. Starts small, gets big very quickly. That's the situation we're in now. We're just ahead of the US stock market open. So I'm really, really fascinated to see what happens. You can see here, we got the VIX rising and then falling. Now, I'll show you what will happen here. This VIX, you can see it's falling. It's now at 30.6. For me, if it gets back down to 24, then this will be the bottom, a near-term bottom in the S&P 500. Now, the S&P 500 has positive reasons to keep gaining. I'll show you the S&P 500 chart. You can see it's in an uptrend. The reason it's in an uptrend is for important reasons. One, the Federal Reserve has promised to keep interest rates low. Two, Jerome Powell last night didn't talk about tapering bond purchases. In other words, the recovery is not imminent. So that's good news for the market because it means easy monetary policy is set to stay. Three, Joe Biden wants to pass a large fiscal stimulus package of $1.9 trillion. All of that means strong gains for the S&P 500. Now, that's why there's been buyers on dips. So I was talking to a group of traders who I speak to every day, and I was explaining that I've bought into this dip. So this bad news I've bought into because I'm expecting this GameStop issue to blow over. Eventually, what would happen is if the situation becomes so bad, what market participants will do is they will increase the margin requirements for retail traders on platforms like Robinhood and Trading 12212. They won't be able to bring down the global financial market. What this lesson has taught us is that, yes, coordinated, leveraged retail investors can impact the world financial markets. It's a pivotal day. It'll go down in the history books. It's very interesting. It's very noteworthy. And a lot of the regular patterns that you see in the market have been out of sync over the last 24 hours. There's a bit of a scramble going on. And what started as a sideshow yesterday quite quickly became the main event. It eclipsed Fed Powell's speech on the latest Federal Reserve interest rate statement. And Jerome Powell, the chair of the Federal Reserve, was actually asked about GameStop stock. So you think if the chief central bank has been asked about GameStop stock, that is a very significant event going on. I don't think it's going to be a big problem because, as I said, eventually they'll just say, well, you can't trade with that leverage. You have to have more margin requirements. So if you want to put on, $250,000 position, then you're going to need $125,000 to do it. And that's going to stop a lot of people entering those markets. So medium term, they'll deal with the problem. But in the short term, it's going to be a huge problem. GameStop could be a problem for AMC, Nokia, BlackBerry, and a lot of retail traders. Some of them are going to make a fortune. Some of them are going to lose a fortune. So it's going to be a very, wow, incredible time. Does that help, Ali?
Yes, yes, thank you, thank you.
Any other question?
I would have a question about the same topic, actually.
Yes.
So one question is, wouldn't this be considered like a type of collusion because people are getting together to manipulate the market?
Yeah, sure. Yeah, exactly, Grace. Isn't it funny? I was thinking, you know, if this was the other way around, I think it just shows you that it's human nature to be social. It's human nature to try to game the system. And you're always going to have people trying to game the system, whether it's insider trading, whether it's people trying to get inside information on central bank decisions, on economic data points. It's always going to happen. And this is just another expression of it. And there was an element of it, Grace, in the forum, which is kind of like, we're fighting the system. We want to bring down governments. We want to make people pay. So there were some people who were clearly in the forums, and it wasn't even about making money. It was just trying to create a storm. So for sure, there's some darker undertones, Grace, involved in what's going on. But I don't think it's, I think it is a form of collusion, and eventually it will be stopped.
And then, do you mind if I ask another question?
No, not at all, Grace.
Would you consider this as type of bubble, maybe, that will just burst after a few short moments? Oh yeah, yeah. I can't see the justification for valuing GameStop stock at like 300% of what it was valued at the start of the week. So it's a huge bubble. If you want to, I'll tell you a film that really makes this point very well. There's a film called, and it's a novel based on Charles Dickens' work called Little Dorrit. And in the film Little Dorrit, there's a man who's seen as the man of the age in London. He's a hedge fund manager. And in the novel, Charles Dickens writes about all these people who get very excited about this hedge fund manager. He can't be wrong. Everything he does touches to gold. It's a risk-free bet. He's the man to put your money in. And everyone puts their money into this hedge fund. And of course, the inevitable happens. The hedge fund ends up collapsing. The man of the age lets everyone down. And people have not diversified. They've put all their money into the situation. And they end up losing all their money. That's exactly what's happening here. You wait in a few weeks' time, there'll be stories of people who got caught up in this. They invested everything and they lost all their money. So it's a good sign of a bubble. And if you look at the forum of Wall Street Bets, you'll just see that people are doing it en masse. There's almost a hysteria in the groups. So I think there could be much more volatility to come. And I don't think it's going to end well. And it's a perfect example of a bubble, because the underlying asset prices does not reflect fair value. All right,
Any
thank you.
Sorry, Grace. Grace, go ahead.
Oh, I just said thank you. Thank you very much.
Okay. Any other question?
I have a question. So,
Yes, Mohammed.
hello, it's good to have you back again.
Thank you, Mohammed.
And I have two questions, if that's fine.
Yes, of course it is.
So my first question is, what's your intake and comment on the high valuations? I'm not sure if you've seen the Shiller PE ratio. It's at .com bubble highs and even higher than the 1929 highs, I think.
Yeah.
And I want to know your point of view on what is known as value investing, the methodology which prominent investors such as Warren Buffett, Charlie Munger, Peter Lynch, and Seth Klarman use.
Yeah.
Thank you.
Yeah, Mohammed. my concern about the trading equities on the PE ratio is that, yes, stock markets are overvalued, but stock markets can end up rising being overvalued for a long period of time. So for me, the thing that's underpinning this stock market rally is not the valuations. The valuations, it's arguable whether they're realistic, but until the Federal Reserve and until Washington decide that they're not going to keep pumping money into the financial system, then this can keep going. So for me, the valuations are not a focus. What is a focus is on the Federal Reserve policy and the US government policy, because now we've got two factors driving stock markets higher. In 2008, 2009, it was central bank policy that was driving stock markets higher. Low interest rates, high levels of quantitative easing, all of that was conducive. And as soon as the central bank started holding back, they started raising interest rates, then we started to see some of the growth slowing down. As long as we have low interest rates, as long as we have Washington prepared to borrow as much money as necessary to support the economies, then I'm not so worried about the overall valuations, because I think the valuations will keep going higher as long as the money is there to push them higher, even if the valuations don't make logical sense. So sometimes you can have a stock that is clearly valued incorrectly, but it will still keep rising anyway. So I don't find it a reliable method to trade on valuations alone. Having said that, obviously, if there was reasons for a bear market, those valuations become much more important. But at the moment, they're less important for the day-to-day trading that I'm involved in. Your second question was about value investing. I think value investing has been a very good principle of investing over the last, sort of 40, 50 years. And whether it's still going to work in our current day and age, I think is another moot question. But I think that people would get many sound principles from value investing, which generally would put them in pretty good stead.
Thank you.
Any other question? Any question? Okay, I have one question. So we know that there is no pricing model yet for cryptocurrencies. Yes. I know there are some papers who are trying to find out the day of the week effect and trying to find the patterns. But do you observe any patterns on cryptocurrencies, or it's too early yet?
Yeah. Now, let me just... I'm just going to pull up. Okay, so I'm just going to pull up the spot rate of Bitcoin. And there are some interesting things that I notice. Now, if you look at Bitcoin and the price of gold, so we're just going to put gold overlay this on the chart. Okay, that's better. So what you can see is that around 2017, the correlation between gold and Bitcoin was virtually zero. They were virtually totally uncorrelated. But recently, that correlation has risen up to 0.44. So some people have started to compare the idea of Bitcoin being a digital gold. Now, I don't think Bitcoin is there yet. If you look at the market capitalization of gold, it's around $9 trillion. Bitcoin has tripled in the last 3 months, but it's still only $600 million. So what I would say is that there is a slight tracking of gold going on. So you can see particularly the drops in the stock markets. We saw a drop in gold and we saw a drop in Bitcoin. And that was some investors liquidating profitable gold positions to pay for those falling equity positions. So one asset that I would be looking at in terms of the pattern for Bitcoin is gold. Now, what I noticed day to day, sometimes they work in tandem and sometimes they go in opposite direction. So it's not a pure correlation. The other asset obviously is the dollar. Because Bitcoin is traded against the dollar, you can see that as the dollar has fallen, that has helped Bitcoin rise. So what I'd be expecting is if the dollar keeps moving higher, I'd expect Bitcoin prices to keep falling. So the dollar's rise at the moment has been on concerns that maybe the US economy is going to recover more quickly than everyone thought. And I did see the IMF came up with a change projection for the US economy this year of growing at 5.1%. So there is, amongst analysts, there's a debate beginning, which is saying, well, perhaps the US dollar will recover. And the argument is in the balance. So the dollar obviously is another key pattern and driver for Bitcoin. But having said that, sometimes Bitcoin is operating and it's not clear what the driver is. So that's all that I've noticed. Does that answer your question?
Yes.
Yeah.
Thank you. Any other question?
Burcu, I'd like to ask some questions about Indian scenarios. Hello.
Hello, Subra.
Yes, please, Subra.
For example, I am a regular investor in SIP, in the mutual fund in India for the last 4 or 5 years.
Yeah.
During the pandemic, actually some of the funds which are in the +7%, +9% annualized return range went down to -25, -26.
Yeah.
Then now it came around +3 or +4. And now actually in this pandemic season, if you take the Indian Sensex, it is increasing a lot. For example, if you take one of the SIP investment I made in last April, it went maybe around 60% up. It is unbelievable. And if you take the Indian GDP is shrinking nowadays, but the Sensex is rising. How do we understand this type of phenomena?
Yeah. Well, when I'm confused, Subra, there's one doctor I like to go to if I'm looking for the health of the economy, and that's Dr. Kapar. And if you look at the chart I have here, I have a copper futures chart. And if you noticed, copper prices dropped heavily on the COVID-19 shutdowns. But what many analysts were talking about was a V-shaped recovery. The expectations were that the world production would drop suddenly, but would pick up suddenly. So you can see here, copper tends to be a good lead indicator about global growth. And you can see copper has been moving higher from all the way in March 2020. So sophisticated investors have been buying into the global recovery since COVID-19 broke out. So the reason we're seeing equity markets rise across the world is because, remember I said about the Federal Reserve, it's the central bank that leads all the others. That huge stimulus package by the Federal Reserve, the huge package coming out of Washington and around the entire globe has meant that money has stayed in the system. We've just taken on more debt to pay for it. So that has meant that companies can stay in place. It's meant that investments in major indices can keep rising. And all of it is based on the future hope of a global recovery. Remember, the key to understanding the markets is they're not really responding necessarily to what's happening right now. What they tend to respond to is what they think is going to happen in 3 months, 6 months, 9 months time. So investors were looking March of last year and looking forward and saying, you know what, eventually this pandemic's going to pass. Eventually the globe is going to recover. So we're going to buy into our copper positions now because we're expecting the global economy to recover. Does that make sense, Subra?
Yes, yes. And there is another speculation that there will be a bubble and the bubble will burst soon. And because if you take the Indian Sensex, it is unbelievable. There is no explanation for that. As I told, when the GDP is going down, and if you take right now, the central bank may increase the interest rate. So there is a speculation that there will be a burst. Will such thing happen maybe in near future?
Yeah, use the interest rate as a good tracker. So what I'm looking at, Subra, is when it comes to, will the bubble burst? For me, because I've been in the markets for quite a few years, and sometimes people can be talking about the bubble bursting for 5, 6, 7, 8 years, Subra.
Okay.
So what that means is it can become like a residual fear that just hangs over you. So in terms of investing, what I'm looking for is what would actually cause markets to fall. So if you look at the S&P 500, it keeps rising higher. Okay, if this falls lower, I'm expecting dip buyers. Now, what would change that scenario? So for me, it would be things like raising interest rates. So if it becomes more expensive to borrow, it suddenly means that companies are going to find it much harder to invest in the future. They're going to find it harder to maintain their current outlay. And that means that companies' earnings should be hit, consumer confidence should be hit, there's less jobs in the economy, there's less consumers. The US economy is a consumer-driven economy. So as long as the interest rates are low and there's support from Washington and the Federal Reserve, I mean, here's a question for you, Subra.
Yes.
And this is just the US, and you can use it for India, but you will find a different answer. Is if the US has problems in the economy, what's it going to do? Have a guess.
Yes. Because actually the speculation in India is going on. Actually, everything expecting what the Biden administration will do now. Based on that, only they are saying that the further trend will be.
Yes. Okay. So if that's the connection, what S&P 500 traders and what they're saying is essentially that if the US hits a problem, it's going to borrow more money. And if it's going to borrow more money, it means that prices can keep going higher. Now you might say, Subra, well, eventually that has to burst, right?
Yes.
Yes. When? No one knows. Now listen, the debt to GDP ratio is over 100% for the US. It's over 100% for the UK. So that's huge levels, and they've all gone up around the world because the world has been borrowing more money. Now, look at Japan, their debt to GDP ratio is over 200%. So you might say, well, when will the bubble burst? Will it burst when the debt to GDP ratio is 140%, 150%, 160? You see, you can't answer that question, Subra.
Yeah, we cannot answer that question.
We cannot answer that question, so we don't know. But I've seen people for years talking about high valuations. The bubble must burst. And I guess, although I agree with the sentiment, you have to see the reason that the bubble isn't bursting is for powerful reasons. And why would serious money be invested in these stock markets if they really thought the bubble was going to burst? So what will give you an indication of the bubble bursting will be central bank policy. It will be when the US administration says, we can no longer lend money. We can no longer take on further debt. It's when, you know what I mean?
Yes, yes.
That's what will be the signal, rather than a theoretical, abstract idea, you know, oh, the valuations are high. You need to look at something concrete. Does that help you to know how to see it in the real world?
Yes, yes.
Because if you think about it, a debt to GDP ratio, it's only important if people consider it important. So I could see a scenario when people say, well, yeah, a debt to GDP ratio of 100% isn't great, but look at Japan, they've managed it over 200%, then so could we. So I could see at least another 10, 15 years of borrowing before this became a real problem.
Yes, yes.
But Subra, in India, if the central bank starts raising interest rates, that should hit the index.
Yeah, but actually in India, there are many things going now, and actually the interest rate is actually going down for the last maybe 7-8 years.
Yeah.
And even if the GDP is going down for the last 2-3 years continuously, the Sensex is actually increasing. This I have noticed. And another thing, as a regular investor, my advisor advised me go for the SIP type of mode. It is cost averaging like that. But when I noticed that during the pandemic, the timing also very important in many cases. Sometimes if you are able to time properly, our return will be much more than even the SIP return. That's why sometimes it's very difficult for me to understand what is happening in this, because I am not a regular observer of all these indices.
Subra, cost averaging is excellent. It's a very effective system. So even for people who are professionals and are looking at the markets every day, timing the markets can be very challenging. So cost averaging is pretty good. Once you've got the broad direction, I think cost averaging is a very excellent system, because there's an old saying, there's timing the market versus time in the market. So basically you're better off being in the market than trying to time it, especially if you're not a professional. And even if you are a professional, it's very hard.
Yes, yes, that's very difficult to say, because the timing, I don't know who can, it is just like a luck. That is what I believe. Because I could not explain the timing using any statistical methods.
Yeah.
Okay, Giles, do you have time for questions, or is it time to finish?
Should we have one or two more?
Okay, any question? Any more question?
I have one more question.
Okay.
I have a question about, I remember last time you talked about your point of view on the price of gold back then.
Yes.
So, yeah, what's your point of view right now on the price of gold?
Hey, that's a great question, Mohammed. I find gold very fascinating at the moment. Right now, let me just call up a gold chart. Right now, gold and silver. Now, I was looking at silver coming into the last Federal Reserve interest rate meeting, which was last night. So this is what I was sort of advising clients. Now, gold and silver trade very similarly, okay? So what I was looking at was I wanted to see whether Jerome Powell was going to mention anything about bond tapering. What had worried the markets? Can you see that sell-off in gold there, Mohammed?
Yes.
This was worry from the market that Jerome Powell and the Federal Reserve were going to start to tapering bond purchases. In other words, would they start reducing the amount of money they're borrowing? If that happened, it would mean that the Federal Reserve is expecting an economic recovery in the US, which means they're expecting interest rates to start rising. If interest rates start rising, you'd expect the US dollar to go up, which would impact the price of gold, And because gold is traded against the dollar, you see gold go down. So if you look at gold, can you see the selling here on the 9th of November?
Yes.
That was on the Pfizer BioNTech vaccine news. So when that news came out, we've got a vaccine. What does the world suddenly think?
Didn't it raise the dollar?
It thinks recovery.
Yeah.
And if there's going to be a recovery, what's going to happen to US interest rates? They're going to go
Up.
And what's going to happen to the US dollar? The US dollar is going to go
Up again.
And what's going to happen to gold?
Down.
Down, right? So you see here, so strong gold selling. So look, this is what helps me understand the gold market. This is telling me the investor sentiment. Recovery, strong sell. Recovery, strong sell. Now, gold has been doing well on low interest rates, high QE, the fact that the US dollar has been losing value. If there's a US economic recovery coming in, then I expect gold to start falling. So gold is now stuck between two stories. The story that helps buyers is low quantitative easing, no tapering of bonds, which was why last night I was looking at buying silver. Now, the reason I didn't buy silver last night was because of the GameStop shenanigans. And I knew, oh, this is ruined the trade. But this morning, I saw how supported silver was, given all the GameStop drama. And so I bought into silver. So I'm happy now, because I'm now up over $1 and a bit on my silver position. So you've got me in a good mood. And that just happened while I was on the webinar. But the philosophy between gold is purely on that. So what I'm looking at here is, do interest rates start rising? If they do, expect gold prices to start falling. Does that make sense, Mohammed?
So yeah, it's dependent on the recovery of the economy.
Yes, yes, you've got it. Because if the US recovers, do you want to hold gold anymore?
No, you would rather hold dollars.
You'd hold anything. Look, do you get anything for holding gold? Do you get any yield? Do you get any dividend?
Nothing.
Nothing, exactly. Look at 2010, 2015. That is the inflationary cycle. When inflation started rising, interest rates started going up, the world was getting back to normal post 2008, 2009. So here's the global financial crisis, low interest rates, high quantitative easing, money's being devalued across the world. Do you want to buy gold? Yes. Then 2011, 2015, interest rates start rising again. Global synchronized recovery. Do you want to hold gold? No. Why? You know, if you hold gold physically, you might have to pay to hold it. So
yeah,
you don't want it, do you? So that's what's going on now. And so we're having this tug of war. Which story is going to win out? For my mind, it's the global economic recovery is going to win out the story, and I'm expecting gold to drift lower. Now, having said that, I wouldn't be surprised if gold had another shot at 2020, 2040. And as I said, you know, I am long silver, which is a very similar trade, but the difference between gold and silver is that silver has industrial usage. So the reason I've chosen silver over gold is that silver, yes, it benefits from the same factors as gold, plus the global recovery helps silver. So that's why I chose silver over gold.
It's more of a safe bet.
Yeah, there's more going for it. There's more going for the asset at this particular time. But obviously with trading, I've got a board, and on my board, I put up the instruments that I'm looking at buying or selling today. Now that can change tomorrow, and it can change back again. And it's on the board, it's there, otherwise I rub it out. So the market dynamics are constantly changing. Like yesterday was a bad day to buy silver, but today was a good day.
Thank you.
You're welcome.
Okay. Any other question? Okay, I think no more question.
Ah, lovely. It's been a pleasure to be with you again.
Thank you very much. It's very informative, very inspiring, and very engaging.
It's been lovely. And don't forget, you can follow me at Twitter as well. I have my Twitter handle is there, Giles Coghlan CCCA. And if ever you want any blogs, if you go to my HYCM blog, I have constantly put new articles on there. And there is some really good, ones, like here's one on silver, which I was talking about. And it's a good way of understanding market dynamics, how it works out in real life. It can be a really fascinating thing to follow. So thank you very much for having me. It's been lovely to be with you again.
Thank you. Thanks a lot.
Thanks now. Goodbye.
Enjoy the rest of the day. Have a nice weekend, everyone. So it's weekend time for Dubai.
Oh yeah, enjoy your weekend. I love to come back to Dubai. I usually come 5 times a year, so I'm missing your sunshine. So enjoy some time for me.
Thank you. Thank you. Hopefully next year.
Yeah, definitely. Goodbye.
Bye. Bye.